So hey there. Welcome to our East Bay Comps and Coffee. This gives us a chance to talk about topics that are important to our clients. People ask us questions all the time about everything in related to real estate and or the East Bay. So we have a special guest today to share some information about something that we have clients asking us all the time. So Rick, we're going to introduce ourselves real quick, and then we'll introduce you as well. So I'm Lisa Doyle, real estate agent here, of course, in the East Bay.
Hey guys, I'm TJ Smith. I'm also a realtor here in the East Bay.
I'm Diana Carcamo, also realtor here in the East Bay.
And I'm Ryan Day, also realtor with Doyle team here in the East Bay.
Yeah, and we all work together, so we love to help clients. And so we have a very special guest. And Rick, thank you so much for joining us today. This is Rick San Vicente. I always have a tongue twister. And Rick, I know you work with Mutual Omaha Mortgage, and you guys specialize in what's called reverse mortgage, right?
Yes, that's our specialty. We don't.
Awesome. Yeah. So share us a little bit about your company, and then I know you're going to go into some details about reverse mortgage and kind of the ins and outs, and how we can better help our clients with information.
Okay. So you've heard of Mutual of Omaha, I'm sure, and we've been in the business for many years. Mutual of Omaha purchased us a couple of years ago. So it's something that Mutual of Omaha feels that we have a lot of customers in the long-term care, Medicare supplement, a whole lot of customers in the 62 plus age bracket already. So they felt that this is another product that really serves that age group. So reverse mortgages are a very useful tool. What it is you have to be 62 or older to be able to take advantage of this program.
Okay.
And there's many different versions of it, and it's really evolved over time. But where I want to start, so you guys can understand, is what is the difference between a regular traditional forward mortgage and a reverse mortgage. So I think sometimes people forget or don't understand what they already have, which is generally a traditional forward mortgage. Okay. So I'm going to ask you just a couple of little questions. Okay. And I expect some wrong answers, so don't worry about it. Okay. Because it's common, but this will take us through what you have now, most likely, and what a reverse mortgage is and the differences, and it'll only make sense. Okay. So like right now you own your house, right? Mm-hmm. Or do you? If you have a mortgage on your house, who owns it?
We do.
Bank. Well, no, the bank, right?
Well, a lot of people do think the bank, Diana. Actually, that's usually the answer I get. The bank owns it. So let me ask you another question. Who pays your property taxes?
We do.
Yeah, we do.
Homeowners insurance.
Us. We do. Yeah.
And who's responsible for making sure the house stays in habitable and nice condition?
We are.
You have to call the bank and ask permission if you want to sell your house.
No.
Right? Why? Because what do they have on the house to protect themselves? What does the bank have to protect themselves?
They have a lien recorded.
Exactly.
Yeah.
Okay. So if you ever sells the house, who gets paid first?
The lender. The lien.
Okay. Because you got a loan on the house. But again, who's on title? You are, right? Who owns the house? You do. Who pays the property taxes? You do. Who pays the homeowner's insurance? You do. Okay. Let's pretend you get a traditional reverse mortgage on your house. Who owns your house?
Same thing. We do, right?
Believe it or not, you do.
It's all the same.
Okay. Everybody thinks the bank takes the house. Don't do a reverse mortgage. It's not true. Okay. Now I'll explain to you why they think the bank owns the house. Okay. But the fundamental truth is you still own the house. You still have to pay your property taxes and homeowners insurance and keep the house habitable. Those are pretty much the only three ways you can get into trouble with the reverse mortgage. Okay.
But Rick, and I apologize for interrupting, but I was thinking that this morning when we were talking about reverse mortgage, the person could get in trouble with all of those things with a regular mortgage too. If you don't pay your property taxes, If you don't maintain the house, there's no difference in those elements,
Exactly.
Yeah.
Good. Well, good point. And so thank you, because I don't have to say that now because you figured that out. So that's awesome. So what does the bank have to protect themselves on a reverse mortgage when you sell the house?
They have a lien.
Thing, right? A lien. So when you sell the house, the bank gets paid first on a reverse, just like on a regular. So here's the difference. Here's why some people think the bank owns the house on a reverse. Okay. When you have a regular mortgage, right? bank loans you this much money. Okay. What are you doing for the next 30 years once you get that mortgage? You're making
Paying it back.
every month, right? So what happens to the size of that lien over time? It
It's small.
eventually goes down and goes away, right? Okay. Now, let's pretend you're doing a reverse mortgage. You're living in a house. You got a big old fat mortgage you don't want to make any payments on anymore. So if you're 62, we'll give you this much. If you're 72, we'll give you this much. If you're 82, we'll give you this much, right? So there's an advantage. It's good to be old in my world. You get more money, okay? So now you've got a reverse mortgage. Are you making a monthly mortgage payment?
No.
No.
So is that balance going to go down?
No.
No. Is it going to stay the same?
No.
No. Because you got to, why do banks exist? We want to make interest, right? Bank makes money getting interest. So every month, how much you owe is going to go up a little. Live in the house 5, 10, 15, 20 years, you're going to end up owing that much money, right? How much money is left over for the kids?
Whatever you haven't used in your mortgage payments, right? Is that
So if you owe this much when you pass away, it's going to totally depend on how much the house is worth when you pass away.
Mhm.
The house is worth this much, you got this much left over for the kids. The house is worth this much, and let's see if I got, sorry, with this vertical, house worth less, right? Guess what? You beat the system. You got more value out of the house than the bank can collect. Kids won't get anything because you used it all up by living there umpteen years, not making a payment.
so here's my question,
Oh.
Rick. What if you outlive the time that your equity, what happens then? Do your heirs have to pay it back? Do they have to make up the difference?
So let me get to that for 1 second here, because I think Diana might have had a question that precedes
Sorry.
yours for a second that might clarify yours. Go ahead.
Well, I was just, it was similar to Lisa's, which was, does the family have an option at that point, to buy it back, or, what would the option be?
Okay. So remember, what is it's just a mortgage, right?
Mhm.
Bank has waited 5, 10, 15, 20 years to get any kind of a payment, right?
Mhm.
At that point, if the house is worth this much and the mortgage is this much, just sell it. Bank will be paid off just like a regular lien, right? If it's upside down, the heirs call up the servicer. They send out a HUD appraiser. They find out the house really is worth less.
Mhm.
So they'll tell you what that value is. And as long as the realtor sells it within 95% of that appraised value, they can collect their full normal 6%.
Mhm.
And the bank just gets that much less, and the kids are off the hook.
Okay.
Kids could also say, I don't want to deal with it. Here, take the keys. But the bottom line is unless the kids do something stupid or fraudulent, they're not responsible for anything more than the house is worth.
Well, as long as the taxes have been paid, right? Which is what we're responsible to do that anyway. Taxes are paid, HOA dues are paid. The house is not destroyed or maintained. It's maintained well. Yeah, because I have to tell you, Rick, over the last maybe 2 years, I've had like 4 or 5 clients use reverse mortgage to move into their houses purchase, which is, I know you're going to be explaining some ins and outs. And I've had several people lately, when I've been the listing agent, the new buyer is getting a reverse mortgage loan, which is why we wanted to bring you on to have you help answer these questions, because people are starting to utilize this tool more, and more people need to understand what it is and why it might be an option, for them.
So the purchase product is really somewhat fairly new compared to where it used to be. So it's starting to take off a lot. And I'm seeing 800 credit score savvy seniors doing this all the time.
Yeah.
The fact of the matter is 80% of the people out there that are retiring have over 50% of their wealth in their house. And not everybody has enough money to retire. So finding a way to buy your new house with this product, you're going to pay a lot less than full price for cash, and have a lot of money left over to add to your retirement account to live off of. Because the fact of the matter is the kids don't want the house.
Right.
The heirs don't want the house. They want the money, right? So either way, you're just liquefying what's available to you so you can live your life out and hopefully have more money left over for the kids, depending on how you live and how long you live.
Yeah, exactly. So that's awesome, Rick. So I know you have some, like a few written slides to show us, kind of walk us through a few things.
Yeah, I'm going to do this little summary for you. So this will help you kind of, solidify what we're talking about. Okay. So when you really get down to it, the simplest way to say what a reverse mortgage is, a reverse mortgage is simply a mortgage whereby the bank is required to be patient.
Mm-hmm.
That makes sense now?
Yeah.
You're not making any monthly mortgage payments. And it could be 5 years, 10 years, 20 years. There is no term on this loan because we don't know how long you're going to live in the house. So, I mean, I've had customers, we've done reverse mortgages for people that are 105. Okay. I'm over 62. A lot of us are over 62. Hopefully you can't tell who's over 62 anymore. So you got customers in that age group and don't even know it, right? So in other words, there's no longer any monthly mortgage payment. The loan still accrues interest, but is paid at the end. And of course, there's some protections like non-recourse protection. In other words, you don't owe more than the house is worth as long as you haven't done something silly. And homeowners still own the home. They retain title. Okay. You still have to pay your property taxes, home insurance, all the other stuff that you would have to on a regular mortgage.
Okay.
Make sense so far?
Mhm.
Yeah, totally makes sense.
Okay. So now that we know what the concept is, let me tell you some common misconceptions. Okay. Because this happens, it's so funny. Even though we've gone through this explanation, people still have these misconceptions. So I'm going to explain. Number one, people say, oh, bank owns the house if I do this. Is that true?
No.
I already know, based on what we just talked about, it's not, because the borrower is on title, just like a regular forward mortgage. Bank only has a lien on the property, just like a regular forward mortgage. And when the borrower dies, the heirs will inherit the property, hopefully not through probate, hopefully through a living trust, right? And the loan will be due then.
Okay.
This will bring up some questions we can answer later, but I just want to go through the four concepts. Okay. Some people are worried. What if when I die, I owe $1 million or $2 million on my $1 million house? Oh my God, I have messed up my heirs. My kids will hate me. No, it's not true, because all reverse mortgages, whether they're HUD, FHA, or jumbos, all reverse mortgages, if they're a real reverse mortgage, have non-recourse protection, as long as there wasn't any fraudulent activity.
Well, why don't we explain what that means, recourse versus non-recourse, Rick, because a lot of people won't understand what that means. I'll let you explain, or I can explain, whichever you'd prefer.
So on a reverse mortgage, non-recourse simply means the only recourse a lender has to get paid is up to, at most, the value of the house.
Right. They can't come after you personally for anything after. Your heirs can't be responsible. Okay.
Yeah. Again, as long as there's no fraudulent activity, they're right. So that's the agreement.
And what would be, I'm sorry to interrupt, I apologize. What would be an example of fraudulent activity? Just so that they have an idea what you mean by that.
An example might be, kids in property, don't tell anybody they inherited the property. Maybe they rent out the property. Maybe they try to move into the property and don't tell anybody.
Okay.
Doing all this stuff. And, bank's not going to look kindly on that, because they've been waiting 20 years and now the kids are playing games.
I see what you're saying. Don't tell them that the parents passed away, whatever. Okay.
Yeah. I mean, bank's going to find out anyway. So it's kind of a silly thing to try to get away with, but, crooks aren't always smart either.
Okay. Thank you.
Number three, you could be forced to move out if the money runs out. Okay. What do you get based on what we just talked about? Do you think that's true?
No.
Because you have the non-recourse protection. And here's the other thing. Let's just say in some cases you don't have a mortgage, okay? But you need an extra monthly payment. And let's just say you pick the tenure option, TENURE, like the professor we couldn't get rid of because he had tenure, right? This is a lifetime payment. So let's just say you're getting a couple grand a month on tenure. Even if we did it when the house was worth this much and now the house is worth half that, and you've already been taking money for 20 years, if you pick the tenure option, it keeps coming no matter what.
Okay.
Okay.
So the bank is taking a risk that there will be enough equity over the time that you're there for them to be paid at the end. That's kind of the gist of it, right?
Pretty much.
Okay.
Yeah, there's a big risk there and a long-term risk there that people forget, right? Might have to make a monthly payment, make a payment if they live too long. Again, we don't know the term of how long you're going to be there. Once the agreement is in place, that agreement stays in place no matter how long you live. Okay. Now, it's not true as long as the borrower has to continue to pay their property taxes, homeowners insurance, all on time, keep the house in habitable condition, and still live in their home as their primary residence.
Right. Okay.
I don't think that's a huge bar, but it is a requirement. We good there, guys?
Yeah.
Yeah.
Okay, so stop me if you have questions. So, as mentioned, homeowners still own their home and they retain title and still pay property taxes. The mortgage is just a lien, like any traditional forward mortgage lien. Okay, I think that's really, really important. People don't understand that. And the main thing we want to make sure of is when we talk about these things with customers, you know, they've all heard stories over the years. I mean, I guarantee you, if you mention this, there'll be some people out there that'll say, oh my God, you're recommending what? Are you kidding me? I've heard these things are horrible. Okay. The good news is HUD has continued to bring in more and more and more and tighter guardrails to the point where, you know, customers can't even hurt themselves if they want to. Because now we even impound property taxes in some cases. Okay, so they can't even miss that.
Yeah.
But they need to know about what I sometimes term it as the new reverse mortgage. That gives them an excuse to get educated on the changes. Okay, it's really important because everybody's got a goofy story about a reverse mortgage. And I could probably explain why whatever happened most of the time. But it's a safe, good product if you use it properly.
Okay.
So what do we see? You know, you guys are going to probably ask, what's the most common customer? What's the proper customer? What I see most often, okay, and we're going to get to the purchase product as well, because that's really important for you guys as realtors. But this means that, you know, we can help homeowners. Most of the time it needs to be 62 plus. Occasionally there's a 60 plus opportunity on a jumbo, but it's 62 plus. What I see people is they're trying to retire, but their cash flow is suffocated by that monthly mortgage payment.
Yeah.
Possible to retire. So this helps people retire, okay? And financial planners are working with us on that a lot as well. They're starting to understand the value of this because people are living longer.
Mm-hmm.
And we have to make that money last longer, right? They want government insured line of credit with no monthly mortgage payment. Okay, kind of a shock absorber for market volatility. So in other words, you know, if you're living off a stock that sells for $100 a share and you need $100 every month to live off of, you sell one stock a month, right? Well, what if that stock takes a hit and the market says now it's only worth $50? You got to sell two of them a month to make the same $100. Your retirement plan is not going to last very long if you keep doing that. So having this extra line of credit available is really helpful.
Yeah.
Okay. You guys just learned a very complicated subject called sequence of returns risk, which is, but that's what it is. And here's another one that you guys are going to like. They want to downsize without having to pay all cash and still be able to not have a monthly mortgage payment.
So I have a question for you, Rick, which it sounds like the answer would be no. So the person getting this loan after 62, retiring, they don't need to have an income to qualify for a reverse mortgage. They just need to have equity. Is that right?
Actually, no.
Okay, so there you go.
It used to be that way. This is one of the guardrails we have to put in place.
Okay.
Because some of the bad stories were some seniors stopped paying their property taxes.
Okay.
And then we have to foreclose on them, just like any mortgage, right?
Right.
But it's bad news. You don't want to do that to somebody over 62. So what we do now is we have to do some light income underwriting, financial analysis to take a look and just say, hey, can they continue to pay their property taxes and their homeowners insurance and their basic stuff based on history? We don't look at credit score, but we do look at credit history.
Okay.
Just basic fundamentals to make sure that they have so we don't really look at ratios either, but we do have a low bar. If they don't satisfy that bar, you can either voluntarily, which I think is really smart, because it's a good value, I think, the way that they do the net present values, but we can impound property taxes and homeowners insurance for the borrowers. And I think it's a great idea, especially as people get older. We do tend to forget stuff, and this will help you protect you even a little bit more.
Yeah, great.
Okay, does this make sense so far? Okay.
Yeah.
So many of our customers nowadays are folks just like you and me. This is now it's going to become a pervasive product someday. Okay. The amount of people that are getting into this age group, the amount of people that don't have proper retirement is just staggering. So there are going to be people just like you and me, people with 800 credit scores even, okay, that simply realize that we are living longer and we need to prudently incorporate housing wealth into the retirement plan to make sure it lasts. So the most common uses are financial planners, customers of financial that can't quite retire right unless we eliminate the monthly mortgage payment. This makes the retirement plan work better. Savvy customers that want a line of credit to absorb market volatility, okay? This is going to be what, personally, this is what I'm going to do with my wife. We're going to buy our next house all cash, and then I'm going to put a line of credit on it because when I die, her income's going to go down.
Mm-hmm.
But if she has this, she can cash this in. And I'm not going to get into the details, but these lines of credits grow like crazy, okay? Depending on what the interest rate is, it grows commensurate with that. So if you start out with a $300,000 line of credit today, by the time I pass away, which hopefully is a long time from now, she's going to have $600,000 or $700,000 available to her as additional income to live off of.
Okay. We'll have that on another meeting. We'll have that explanation on another meeting.
All right. Customers are in their 80s. Okay. They need in-home care. They never had an opportunity to buy long-term care. The kids can't afford to help mom and dad. What are we going to do? How are we going to pay for this? So they get a line of credit for in-home care, right? And they live off of that for a couple of years to stay at home. And then the customers that want to downsize, instead of paying, $800,000, $900,000 all cash to get no monthly mortgage payment, you pay significantly less than that, which we're going to show you. Okay. So what I'd like to do right now is, Ryan, there is a little video, the Tom and Sarah one. Maybe we can show that.
Yeah, let me get that on there.
Guys. So what that's going to be, let me just introduce it. So we've been talking about a regular reverse mortgage to stay in your home. This one, before you play it, don't hit it yet, talks about a reverse mortgage. We call this one the HECM for purchase because it's easier to explain, and it's easier on the customer's ears. They're more likely to get educated on that if you call it a HECM for purchase, okay?
Okay.
Like a reverse mortgage in some ways, but it's different on the front end because it helps you buy the new primary residence you're going to move into. So it has nothing to do with the old house. We're putting this on the new house you're going to move into, okay? And this is why it's a powerful tool for the customer and for you realtors to know about it, because this helps them afford the house. How many times do you have a customer that says, this is my budget, but everything they like is a little bit more than their budget.
Yeah.
This helps them mitigate that and still have money left in their retirement account. So
Okay.
if you can go ahead and play this.
Now we have like 2 or 3 buyers who are purchasing our listings right now with this tool.
Tom and Sarah are nearing retirement, and the house they've lived in for the past 35 years no longer fits their lifestyle plan. Although they love living in a home that's paid for, they know that maintaining an aging home will be challenging, not to mention the burden of navigating stairs. So recently, they decided to look into purchasing a new home. The problem is, they haven't been home shopping for over 30 years, and taking out a mortgage while on a fixed income in retirement concerns them. Tom and Sarah know that paying cash for their next home is probably the best purchase strategy, but aren't sure they can get the home they really want using only the proceeds from the sale of their existing home. They don't want to tap into their retirement accounts either because they fear running out of money at some point in the future. Tom and Sarah purchased their current home in 1977 for $57,900, and now they own their home free and clear. A trusted realtor in the area told them that their house is valued at approximately $486,000. After closing costs and realtor fees, they'll net about $448,000 when they sell their home. So, with a budget of $448,000, Tom and Sarah begin the search for their dream home. Tom and Sarah don't always agree on everything, but one thing they do agree on is this. This may be the last home they purchase, and they want it to have things like single-story living, modern design, an upgraded kitchen, outdoor living space, and low maintenance. So, on a sunny Saturday morning, Tom and Sarah map out 3 homes they want to visit. After touring the first home, Sarah asked the sales agent, "How much does this home cost?" $700,000, ma'am, exclaims the friendly agent. That's a whopping $252,000 over Tom and Sarah's budget. Their dreams quickly turned to disappointment. The friendly sales agent mentioned that there's a unique loan program that they should really consider because it was designed just for them. He went on to explain a strategy that middle-income and affluent boomers like Tom and Sarah have been using since 2009 to purchase their dream home. He told them about the Home Equity Conversion Mortgage for Purchasing Program, or H4P program for short. What makes this program unique is that it only requires a one-time payment of about 50% of the price of the home. And then there are no monthly mortgage payments for the rest of your life. You remain responsible for home maintenance and the payment of property taxes, home insurance, and any HOA fees. Tom and Sarah realized they actually can afford the $700,000 home on this program, and that they are effectively doubling their purchasing power compared to paying cash or taking out a regular mortgage. The new H4P program is for those ages 62 and up. It's an FHA insured program that simply requires a one-time down payment of about 50% of the purchase price and does not require a mortgage payment as long as you live in the home. Remember that home maintenance and payment of property taxes and insurance are ongoing program requirements. Discover how you can buy the home you really want without tying up a large portion of your savings. Take the next step and learn more. Contact us today to learn why we're the nation's largest H4P lender with loan specialists in 48 states.
Awesome.
So we call that the Heck'em for purchase.
Okay.
We also, so that was done a few months ago. Interest rates have declined, as you well know, and that's always good for everybody. So the ratios are literally even a little bit better today. And also we do have a jumbo program. So why don't you show Ryan? Can you show? Oh, you can't. You probably can't do that one. So let me show you
The next one, or
No. Why don't you unshare and let me.
Welcome to Mutual of Omaha Mortgage.
No, please.
Did you know we have an
Turn that one off? Thank you.
Little technology experience there.
Yeah. So let me show you what I'm gonna have here.
Hey, Rick, while you're pulling that up, what if one spouse is over 62 and the other is under? Can they still do this?
So yes, you can.
Okay, curious.
So hang on a minute, see if I can find you guys here. This is all technology crazy here. So yeah, you absolutely you can. I've actually done it where he was 70 something and she was 48. But remember, we have to take everybody's age into account.
Yeah.
So because she was so much younger, the down payment might be a little bit bigger because, you know, it's got to last for as long as she lives as well.
Right. Okay.
Okay. So on a purchase, yes, there are some idiosyncrasies that we can get away with on the purchase that we can on the other stuff, because there's reasons why you don't want to do stuff like that on a regular reverse mortgage, but on a purchase, I think it's totally appropriate.
Okay. Just curious.
So hang on a minute. Where is my share? There's so many windows to share with. So I want to show you this. Is one that we just pulled up last night. I didn't get permission for it. So Lisa, if you recognize the realtor, please don't get mad at me.
It's all good.
But
We love our fellow realtors. We're good with that.
All right. So here's a listing in Danville. House sells for 1.499. It's being offered at that. Okay.
Okay.
And so we can. So let me show you something. Remind me later, because we can create this stuff for you guys if you're trying to land a listing. You know, you might tell, your customers might say, hey, why should I use you? You got 101 reasons why they should use you. Well, here's 102 reasons why. Because you can literally, what if you told your customer, if I could sell your house for this much money, would you get more buyers? And you're opening up the market dramatically with this. As you can see with this product, your down payment, if you were 62, would be $871 on a $1.5 million house. Monthly mortgage payments. At 65, it's 834. At 70, it's 777. It goes all the way down to 662.
Okay.
Okay. Can you see the power of that? Because the boomers are now being called chasers, right? Because we're chasing our grandkids and we're following our grandkids wherever they're going. Sometimes our grandkids are in San Francisco and we lived in Stockton. Sometimes our grandkids are someplace else. It's a little more expensive than where we used to live, but we still want to be there. How are we going to make that happen? Okay. So this is an example of how we can make that happen. So again, let me be upfront with all this kind of stuff. You guys can ask any questions you want. On the HECM for purchase, we have, we want to go through the pre-approval process. That's very, very important. I have problems when the realtor calls up. Hey, we already got him in contract. Haven't even got him canceled. I got a 7-day cooling off period. I got all this stuff and I'm behind the 8 ball trying to get this thing done in less than 30 days.
Yeah.
So if you can get these customers pre-approved, we close them in less than 30 all the time. I've closed them in 2 weeks frequently if the appraisal comes in quickly and HUD doesn't require 2 appraisals.
Okay.
That's the only 8 ball. If we do the jumbo, okay, for purchase, I have to be upfront. At this time, we don't have the timelines that tight yet because we have to go through a couple of other steps and the jumbo's just not there yet. So we can do a pre-approval for the jumbos.
Okay.
So if you stay under 2 million, I'm only going to have to do 1 appraisal, but I'm going to have to ask for a little bit more than 30 days on those.
Okay. So you think maybe like 45 days or so to 60 days?
Yeah.
Average. Okay.
Yeah. I mean, unless the appraisals, are hard to get and they don't come in very fast, but yeah. But it's a powerful tool. I mean, especially as the market slows down and hopefully the sellers are a little bit more flexible.
Mm-hmm. So that's awesome. So we have a couple questions that our clients have asked us over this time, Rick. What if the parents get this loan from you and they're in their, like, let's say they're in their 70s and they decide within 5 years or so that they want to move on to maybe an assisted living, they can sell the house. Is that right? That's not a problem?
Well, let me ask you, what do you think?
Yeah. I mean, I would say yes, but I wanted you to answer the question because I've had clients ask.
Yeah. Because what is it? Why can we do
to them? Yeah.
Because it's just a lien, like any other mortgage.
Yeah.
So,
and they've only used 5 years of their equity, so
they probably have more money to take with them, right?
All right. Awesome.
Yeah, absolutely.
Yeah, very good.
So I think what people forget, and thank you for asking the question, Lisa, is they forget this is very similar to a regular mortgage. The only difference is how much you owe goes up a little bit because you're not making any payments.
Right.
Living off the house. So the payoff's going to be a little bit bigger when you sell the house. Mm-hmm. Still your house.
Yeah.
Just a lien that gets paid off.
Awesome. And the only other thing that I've had clients ask, I know Ryan, we were talking about this earlier about if they pass. So what was your client asking you? I'll let you.
Well, as far as, when they, maybe eventually pass away, right? What happens to the house, the logistics, as far as the heirs, or what if they pass away with no heirs?
Okay. So first off, do they have a living trust?
Well, as far as my client, no.
Okay. So most likely they're going to go through probate.
Mm-hmm. Okay. And what if they have a living trust?
Excuse me?
And what if they have a living trust?
Then they don't have to go through probate, and it's pretty fast and simple. We know immediately who owns the house, right?
Exactly.
Trust, the heirs immediately own the house. They can do what they want.
Well, I think the biggest question is, I know that you scope out, and I know you and I've talked about this, so I know the answer, but I want to make sure that the consumers understand. If your parents, like, let's say it's your parents' home and they've got a reverse mortgage 5 years ago, and they've used 100,000, 50,000 of their proceed, they can still sell the house, and the heirs get the rest of the money. It's not like they're going to lose that. I think that's the biggest concern is that they would.
Yeah. And you can always call me. I'll help you. But it won't be a transaction I'm going to do, but I can help you. But you would just get a monthly mortgage statement that mom and dad get, and you have a pretty close idea of what the payoff would be. So it's been fairly current, right? Okay. So you just sell it like a regular mortgage, and you know what the payoff's going to be, and the heirs get what's left. Okay. Yeah. The only time there's going to be a problem is if there's no living trust. It might be tough because we don't know who owns the house until probate has been completed, right? Yeah. And probate could take a couple of years. The reverse mortgage must be satisfied within, certainly less than a year, but you don't get a year. The heirs have to work with them. The lender wants to get paid right away. But if probate hasn't been solved by then, you're going to have some issues, right? Well,
that would be advice. I mean, we always share with our clients, always make sure that they speak with a consultant that can help them prepare a trust. That would be advice that we would always give anyone who especially pursues this, this option, is make sure that your home is in a trust. So.
Yeah, I think that's good advice, Lisa.
For sure. Yeah. Well, gosh, Rick, thank you so much. Ryan, is there any other questions that you would have or that you think our clients would have? I know I've jumped in with a few.
And Rick's detail went over all of them.
Yeah. Gosh, thank you so much for helping us, Rick.
So there's just one last thing I want you guys to see.
Okay.
Ryan, can you let me unshare here? Or I did unshare. There's a little video, the last video, and
let's see.
What it is it shows that there's actually a phone app you can download. It's not going to be super accurate, but it'll give you ideas, and that's the HECM for purchase. Okay, it's not the jumbo for purchase.
Okay.
And maybe share that real quick there, Ryan.
And tell the consumer what's the difference between the jumbo and the HECM. What's the dollar figure?
Well, if you have a customer, we'll look at all products and figure out which one makes the most sense.
Okay.
Generally speaking, the higher the value home, once you get over $1 million or so, the jumbo becomes a viable option, and we'll look at both.
Okay. Awesome.
Welcome to Mutual of Omaha Mortgage. Did you know we have an app? You can quickly figure out how to buy your next dream home with a HECM for purchase. From the convenience of your home, you'll be able to calculate your one-time down payment to never make another mortgage payment again. Download the H4P app today and see what Mutual of Omaha Mortgage can do for you.
Awesome.
Okay.
Yeah, very good. So Rick, thank you so much for your help today. We'll be sharing this, of course, with clients that have questions about this, and we'll make sure that we get them to you, that you can answer their personal, go over their personal scenario. But we so appreciate your help, and we wish you a very Merry Christmas, Happy New Year, and
thank you. Happy
you
holidays.
Guys too. I hope your kids come home, or you go see your parents, and you guys get to enjoy what we get that close Christmas this year, hopefully.
Exactly. Yeah. You take care. Stay well. Thanks for your help. All right. See you soon.
Bye-bye.
Bye.